When markets crash, headlines blame inflation. When currencies fall, analysts blame policy mistakes. When debt explodes, politicians blame each other. But what if the real story isn't chaos, but coordination? What if behind interest rate decisions, emergency bailouts, liquidity injections, and currency swaps, there exists a quiet network, not a secret society in a dark room, but a structured institutional web of central banks, global financial institutions, and policy alliances that shape the flow of trillions. You don't vote for it, you rarely hear about it, yet it influences your mortgage rate, your savings, your job market, and even the value of your currency. Tonight, we trace the origins, the rise, the breaking points, and the modern evolution of the quiet network that controls global financial power. Part 1. Origins. From national banking to global coordination. To understand the network, we go back to the early 20th century. Before World War I, financial systems were largely national. Countries operated under the gold standard. Money was tied to metal. Exchange rates were fixed. But war changed everything. Governments needed to finance massive military spending. Gold constraints became restricted. Debt ballooned. When the global economy collapsed in the 1930s, it revealed something profound. National monetary policy was no longer enough in an interconnected world. After World War II, a new system emerged. In 1944, at Bretton Woods, global leaders created institutions designed to stabilize the international economy. The International Monetary Fund, the World Bank. The US dollar became the anchor of global trade. Central banks coordinated to maintain fixed exchange rates. For the first time, financial power was institutionalized at a global level. It was presented as stability. It was also centralization. Part 2. The rise. From gold to fiat and expanding influence. In 1971, everything shifted. President Richard Nixon ended the dollar's convertibility into gold. The gold standard ended. Fiat currency ended. Money was backed not by metal, but by trust in institutions. This gave central banks extraordinary flexibility. They could expand money supply without gold constraints. They could manage inflation, employment, and liquidity directly. The quiet network expanded. Central banks began coordinating more closely. Currency swap lines, joint policy announcements, coordinated rate cuts. At the center sat institutions like the Federal Reserve, the European Central Bank, the Bank for International Settlements. The Bank for International Settlements, often called the Central Bank of Central Banks, became a hub for policy coordination. This wasn't a conspiracy. It was structural alignment. Structure creates power, and power rarely shrinks. Part 3. The breaking point. 2008. The 2008 financial crisis exposed the scale of the network. When global banks faced collapse, central banks didn't act alone. They acted together. The Federal Reserve opened international swap lines, providing dollar liquidity to foreign central banks. Emergency lending facilities expanded rapidly. Interest rates were slashed globally in months. Trillions were injected into the system. Financial markets stabilized. But something changed permanently. After 2008, central bank balance sheets exploded. Government debt surged. Asset prices recovered faster than wages. The network had proven its ability to prevent collapse. But it also demonstrated something else. Financial survival now depended on coordinated intervention. Markets no longer operated purely on private risk. They operated with the expectation of rescue. Part 4. Fallout. The age of dependency. Post-2008, quantitative easing became normal. Central banks purchased government bonds, corporate bonds, even exchange-traded funds in some regions. Interest rates hovered near zero for over a decade. Global debt climbed above $300 trillion. Investors adjusted behavior accordingly. Risk-taking increased because liquidity was abundant. Asset prices inflated because money was cheap. The quiet network had become the backbone of global markets. But dependency creates fragility. Markets rely on constant support. What happens when support tightens? Part 5. Failed fixes and new tensions. When inflation surged after the pandemic, central banks faced a dilemma. Years of expansionary policy had fueled asset growth. But rising prices demanded tightening. Interest rates rose rapidly. Liquidity contracted. financial stress reappeared in banking systems, bond markets, and emerging economies. The same institutions that expanded aggressively now had to pull back. And once again, coordination emerged. Emergency lending programs resurfaced, swap lines reopened, temporary liquidity measures appeared. The pattern repeated. Expansion gives imbalance, gives tightening, gives stress, gives coordinated rescue. Each cycle deepened the network's importance. Each crisis reinforced its authority. Part 6. Modern Parallels, Digital Currency, and Surveillance Concerns. Today, over 100 countries are exploring central bank digital currencies. If implemented, these systems would allow direct digital issuance of national currencies, faster payments, greater efficiency, but also greater visibility, greater programmability, greater centralized control over monetary flows. The quiet network may soon operate not only through banks, but through digital wallets. At the same time, global debt remains historically high. Asset markets remain sensitive to rate changes. Trade tensions fragment globalization. And central banks continue coordinating behind the scenes. Not secretly, but quietly. Because financial plumbing rarely makes headlines. The pattern behind the power. Here's the key insight. The quiet network did not emerge overnight. It grew in response to crises. Every major breakdown expanded coordination. The Great Depression strengthened monetary institutions. Bretton Woods centralized currency alignment. 2008 globalized liquidity response. Pandemic stimulus synchronized fiscal and monetary expansion. Each time instability arose, authority consolidated. It's not through force. Through necessity. Necessity is the most powerful justification in economic policy. 3 clear takeaways. 1. Global financial power is institutional, not individual. No single person controls the system. Power lies in aligned institutions, coordinated policy, and shared incentives. The network functions because its members face similar risks and act to preserve systemic stability. 2. Crises expand centralization. Financial emergencies justify extraordinary measures. Temporary tools become permanent frameworks. Balance sheets grow. Coordination deepens. Power accumulates quietly. 3. Stability and dependency are linked. Network prevents collapse. But markets increasingly depend on intervention. That dependency shapes risk, behavior, asset pricing, and debt growth. Stability today may create fragility tomorrow. A final warning. The quiet network is not inherently evil. It is a product of complexity. But complexity concentrates influence. When decision-making becomes centralized across borders, transparency matters more than ever. Because global financial power affects everyone, savers, workers, businesses, governments, the next crisis will test the network again. The question is not whether it will act. The question is how much more power will consolidate when it does. Call to action. If you want to understand how central banking coordination, global debt systems, and monetary policies shape your financial future, subscribe now. Because the forces shaping global markets rarely announce themselves loudly. They operate quietly. And the more you understand the structure behind the system, the better prepared you are when the next shift arrives.